The Nikkei faced a surprising downturn despite briefly breaking through the significant 44,000-point threshold, a development that reveals the complex dance between optimism and caution in today's market. But here's where it gets controversial. Can a stronger yen, a seemingly positive economic sign, actually hurt Japan's stock momentum? And this is the part most people miss about why profit-taking rapidly sets in after record highs. On Tuesday, the Nikkei 225 index in Tokyo showed a volatile performance. Early in the trading session, it climbed sharply, reaching an all-time intraday peak of 44,185.73 points, marking a stunning 1.24% gain. However, by the close of the day, the index had slipped by 0.4%, settling at 43,459.29 and ending a three-day streak of increases. Meanwhile, the broader market measure, the Topix index, also gave back some ground, finishing about 0.5% lower. Why the reversal after such a promising start? The initial surge came on the back of hopes for more aggressive government spending policies. This optimism was triggered by the recent resignation of Japan's fiscal hawk, Prime Minister Shigeru Ishiba, raising expectations that the upcoming fiscal debates in the autumn might lean towards expansionary measures. Analysts at Bank of America Securities commented that the government would likely seek support from opposition parties, all advocating for pro-growth fiscal initiatives. Such cooperation could signal increased stimulus to boost the economy. However, that positive momentum faltered as the Japanese yen began to strengthen against the US dollar, gaining about 0.5% to reach 146.80 yen per dollar. For Japanese exporters, a stronger yen means their products become more expensive overseas, putting downward pressure on profit margins and dampening investor enthusiasm. This currency effect was often overlooked, but can quickly change the stock market landscape. Adding to the market's complexity, Japan's chief trade negotiator, Ryosei Akazawa, announced on the social platform X that U.S. tariffs on Japanese automobiles are scheduled to be reduced by September 16. Removing some uncertainty surrounding a trade deal initially outlined in July. Yet, Akazawa pointed out that the so-called most favored nation status was not extended to critical sectors like pharmaceuticals and semiconductors under an executive order signed by former U.S. President Donald Trump. This partial coverage has stirred mixed reactions. The pharmaceutical sector felt the impact immediately. Takeda Pharmaceutical, Japan's largest drug maker, dropped 3%. One of the day's biggest decliners was Citizen Watch, which plunged 5.5% after the Nikkei 225 index's official announcement on Monday that Citizen will be removed from the Nikkei 225 starting in October. Such removal often shakes investor confidence, leading to sell-offs. On the flip side, technology and chip-related stocks shone brightly. Advantest, which supplies testing equipment for semiconductor giant NVIDIA, soared by 6.5% to set a fresh record high. Other winners included Screen Holdings and Tokyo Electron, makers of chip-making machinery, which gained 2.4% and 2% respectively. These surges highlight a continued investor appetite for tech stocks despite broader market headwinds. This intricate interplay of government policy shifts, currency fluctuations, trade agreements, and sector-specific news illustrates just how multifaceted market movements can be, from euphoric highs to cautious profit-taking in a matter of hours. So here's the question to you. Do you think the yen's strength is an overlooked threat to Japan's export-driven economy, or is it a sign of underlying economic stability? And how much influence should fiscal policy shifts really have on investor confidence? These nuances are essential for anyone watching Japan's markets, and we'd love to hear your thoughts. Agree or disagree, let's get the conversation started.